In this lesson, we are going to learn how to account for the sale or disposal of a non-current fixed asset and how to calculate and record gain or loss on disposal. Disposal of a non-current asset means selling, scrapping, or removing an asset from the business. When an asset is sold, it must be removed from the accounting records, and we must check whether the business has made a gain or a loss. Gain or loss on disposal arises when we compare the sale proceeds with the net book value of the asset at the date of sale. Gain or loss on disposal equals sale proceeds minus net book value. Sale proceeds are the cash or amount received from selling an asset. Net book value is the cost of the asset minus accumulated depreciation. We do not compare the selling price with the original cost. We always compare the selling price with the net book value because accumulated depreciation has already reduced the value of the asset over time. If the sale proceeds are more than the net book value, the business makes a gain. For an example, the sale proceeds are $20,000. The net book value is $15,000. $20,000 minus $15,000 gives us $5,000. Because the cash received is higher than the value of the asset in the accounts, the business has made a gain of $5,000. If the sale proceeds are less than the net book value, the business makes a loss. Look at the second example. The sale proceeds are $3,000. The net book value is $4,000. $3,000 minus $4,000 gives a difference of $1,000. In this case, the business received less cash than the value of the asset in the books. That shortfall of $1,000 is a loss on disposal. So a loss happens when an asset is sold for less than its net book value. Any gain or loss goes to the profit or loss account in the period in which the asset is sold. Gains appear on the credit side of the profit or loss. Losses appear on the debit side of the profit or loss account. Now let's go through the 4 accounting steps, in order. These steps are the same whether the question gives a gain or a loss. Step 1 is to record the cash received. When we sell an asset, the business receives cash or money into the bank. That means we debit the bank account with the sale proceeds. Step 2 is to remove the asset from the books. Remember, non-current assets are always recorded at original cost, not net book value. So when the asset is sold, we must remove it at cost. Assets leave the books at cost, not at net book value. Step 3 is to remove the accumulated depreciation. Accumulated depreciation represents the total depreciation charged on the asset over its life. When the asset is disposed of, that accumulated depreciation must also be removed. So we debit the accumulated depreciation account with the total accumulated depreciation to date. At this point, both the asset and its depreciation have been cleared from the balance sheet. We never leave accumulated depreciation behind when the asset is sold. Step 4 is where we recognize whether the business has made a gain or a loss. To decide this, we compare the sale proceeds with the net book value. If the sale proceeds are greater than the net book value, the business makes a gain, and we credit profit or loss. If the sale proceeds are less than the net book value, the business makes a loss, and we debit profit or loss account. So the gain or loss is always recorded in the profit and loss account, never in the asset account. Let's go through first example when a business makes a gain on disposal. A business buys a machine for $10,000. That is the cost of the non-current asset, and that's the amount we record in the asset account. Now, the machine is depreciated at $2,000 per year. We're told that after 3 years, accumulated depreciation will be 2,000 times 3, which equals 6,000. Finally, the business sells the machine for $5,000. So we have 4 key numbers: cost, annual depreciation, accumulated depreciation after 3 years, and sale proceeds. Now, the question is, did we make a gain or a loss? To answer that, we must calculate the net book value first. Let's calculate net book value and then compare it to the selling price. Net book value is the value of the asset in the accounts at the date of disposal. And the formula is net book value equals asset cost minus accumulated depreciation. So net book value is $4,000. So at the point we sell it, the asset is worth £4,000 in our books. Step 2. Compare sale proceeds with net book value. The machine is sold for £5,000, so sale proceeds is £5,000, net book value is £4,000. Because the selling price is higher than the net book value, we make a gain. Gain is £5,000 minus £4,000 equals £1,000. Gain on disposal happens when sale proceeds are greater than net book value. Now that we know the gain is £1,000, let's see how this builds up over time in the accounts. Now this slide shows how the numbers appear across the years and where they end up. Asset is in the balance sheet. At year 0, when we buy the machine, the asset is recorded at £10,000. That's the cost, and it sits in the balance sheet. Yearly depreciation is in profit or loss. Each year, we charge depreciation of £2,000 on a straight line basis. So year 1 is £2,000, year 2 is £2,000 as well, and so on. Depreciation is an expense. That's why it goes to profit or loss. Accumulated depreciation is in the balance sheet. Accumulated depreciation builds up over time. At the end of year 1 is £2,000. At the end of year 2 is £4,000. At the end of year 3 is £6,000. This is not an expense each time. It's the total depreciation collected in the balance sheet. When we sell the asset at the end of year 3, we receive £5,000. And finally, the gain of £1,000 appears only at year 3, the year we sell the asset, and this goes into profit or loss account. We calculate this gain using formula sale proceeds minus net book value equals £1,000 gain on disposal. Once we have calculated the gain of £1,000, we then remove the asset from the balance sheet. We do this by removing the asset at cost and removing the accumulated depreciation. Because both the asset and its accumulated depreciation are now gone, there is no remaining value left in the balance sheet. That's why the net book value becomes 0, not because the asset lost value, but because the asset no longer exists in the accounts. Now let's record the actual double entries at the point we sell the asset. First, look at the bank account. The business sells the machine and receives £5,000 in cash, so we debit the bank account with £5,000. This shows the increase in cash. Next, look at the asset account. The machine was originally recorded at a cost of £10,000. When the asset is sold, it must be removed from the books at cost, so we credit the asset account with £10,000. This removes the asset completely from the balance sheet at cost. Now look at the accumulated depreciation account. Over 3 years, total depreciation charged is £6,000. When the asset is disposed of, the accumulated depreciation must also be removed. So we debit accumulated depreciation with £6,000, clearing the account. We never leave accumulated depreciation behind once the asset is sold or disposed. Finally, we record the gain on disposal. We calculated earlier that the sale proceeds of £5,000 are higher than the net book value of £4,000, giving a gain of £1,000. This gain increases profit, so it is credited to the profit and loss account. So at this point, the asset is removed, the accumulated depreciation is removed, cash is received, and the gain is recognised in profit or loss. Now that we've seen the accounting entries visually, let's summarise everything neatly in a journal entry. We debit cash with £5,000 because cash has increased. We debit accumulated depreciation with £6,000 to remove it from the books. We credit the asset account with £10,000 to remove the asset at cost. And we credit gain on disposal with £1,000 because the business made a profit. We add up the debits and the credits, which confirms our entries are correct. This journal is simply a summary of what we already saw in the T accounts. Let's look at a loss on disposal example. This example is exactly the same asset as before. The only difference is the selling price. The business buys a machine for £10,000, depreciates it over 3 years, and then sells it, but this time for only £1,000. We use same method, but different outcome. First, we calculate the net book value. Next, we compare sale proceeds with net book value. The asset is sold for £1,000. The net book value is £4,000. Because the sale proceeds are less than the net book value, the business makes a loss. The loss is £3,000. Next, we look at the asset, net book value, and accumulated depreciation tables. Notice that the asset remains at cost until it is sold. Accumulated depreciation builds up each year. Once the asset is disposed of, both the asset and accumulated depreciation are removed, so the net book value becomes zero. The £3,000 loss appears in the profit and loss account in the year of disposal. Now, let's record the accounting entries. We debit bank with £1,000, cash received. We credit the asset with £10,000, removing it at cost. We debit accumulated depreciation with £6,000, removing it. The £3,000 difference is a loss, so we debit profit and loss. This is the only difference from the profit example. The loss is debited, not credited. This journal summarizes what we've already seen in the T accounts. Debit cash, £1,000. Debit accumulated depreciation, £6,000. Debit loss on disposal, £3,000. And credit asset, £10,000. Debits equal credits, so the entry is complete. Whether it's a profit or a loss, the steps never change. The only difference is whether the balancing figure goes to gain or loss in the profit and loss account.